Welcome everyone to Fireside Chat on navigating capital markets. I'm Nisha Sridhar, Marketing and Events Manager, and it's great to see you all here today. It is with gratitude and respect that we acknowledge the lands on which Foresight operates are the traditional, ancestral, and unceded territories of the First Nations, Inuit, and Métis people. And for myself, I'm speaking to you from Calgary, which is within the Treaty 7 territory. These are the traditional lands of the Blackfoot Confederacy, the Siksika, Guinai, and Piikani First Nations, the Tsuut'ina First Nation, and Stoney Nakoda First Nations. Before we start, I want to say a few words about Foresight. Foresight is Canada's clean tech accelerator, and our goal is to make Canada the first G7 country to reach net zero. We work tirelessly to position Canada as a global leader in clean technology. We bring together clean tech innovators, industry partners, investors, government, and academia to address today's most urgent climate issues and support a global transition to a green economy. Before we begin, here are a few housekeeping notes. Please use the Q&A option to post your questions to the panel. This session will be recorded and you will receive the recording in a couple of days. It's my pleasure to introduce our panelists today, Moen Ghiashi, Principal from Green Sky Ventures, and Randy Thompson, Chairman and CEO of Valhalla Capital. Over to our moderator, James Shapea from Foresight, who will introduce the panel. Over to you, James.
Thanks, Nisha. I'm actually going to let the gentlemen introduce themselves momentarily. And I'll just introduce what we're really wanting to get the guys together. I've known these guys for years. They're fantastic. They know absolutely, if there's anything you want to know about capital markets, we're afraid to ask. These are the guys to do it. Why do we continually do a repeat of the capital markets updates? Because capital markets are cyclical, they change, and they're important to know where you stand in the cycle. There's some interesting points that you're going to hear later today about how to navigate the capital markets and the changes that as they're taking place to know how do you advance your company. So this, I like to say, with respect to growing and taking our company's advancement, it's all about access to capital. But capital truly is both intellectual and financial. Intellectual is key to your being able to execute. Financial is being a key to being able to get those people to allow you to execute. So we'll get into the capital markets momentarily, but let me just turn it over and start with Moen. Could you please just give the people a little bit of a background on yourself?
Yeah, absolutely. Moen Ghiashi, I'm a principal with Green Sky Ventures. I'm a material scientist by training. So before becoming a venture capitalist, I was a scientist. That was my life. I wanted to be always an academic. Then I realized that we have an issue with commercialization of science, and I got very interested in being able to help startup companies commercialize their technology. And I found my way to venture capital, helping venture capitalists better understand science and also being able to translate the science that the entrepreneurs are working on so that they can get connected to the capital and help them grow. I've worked at Green Sky Ventures. We are a Canadian venture capital firm. We invest across B2B early stage Canadian startups with an average check size of $1.5 million. At Green Sky, I lead the deeper tech investments, which are more focused on industrial innovation, clean tech, health tech, etc.
Thanks, Moen. Randy.
Hi. Hello, everybody. By the way, I've been stalking all of you, looking at the participants list, and great to see some Valhalla members here. So there's some angel investors on here today. And there's a name I've got to give a shout out to James, because what James said is if Moen and I don't know it, it's because we haven't seen it. What he was actually saying is we're old. And so Henry Katarna's on the call, and Henry ran an angel group with me for tons and tons of years, a different group, but it's great to see some names and faces from the industry so they can call out my shit when I get something wrong. So I started as an entrepreneur, had the first internet service provider in the province of Alberta. And we did everything possibly wrong we could do. And we stumbled our way to an exit. So when we finished the exit, I said, we have to change the attitude of those awful investors. And all they do is oil and gas and real estate in Alberta. I'm a former BC boy. So when we started an angel group back in 2003, it was because I was an entrepreneur who thought investors got it wrong. So what's really interesting after 20 years of conditioning, I'm going to call it, I've really gotten a sense of the language between investors and entrepreneurs. I've done 110 angel investments myself. Our group, Valhalla Private Capital, as it used to be called VA Angels, is now Valhalla. We funded about 350 startups, put about 80 million in there. And part of what we want to talk about today is the being agnostic about capital. So our group got out of kind of angel investing and started to do our own funds. And our largest one's a venture debt fund called Old Kent Road Financial. So we do bridge financings for startups. And that fund's about 130 million. So we get to talk today, Moyen and I, about, just being agnostic about pushing you into like an angel or venture runway. I know Moyen's got some background as well with venture debt. So we'll talk about finding the right tool for where you are as a company. And that's what we've tried to do as at Valhalla. So 2-time Angel of the Year and own a football club in England. So that'll do it.
Thanks, Randy. Okay, so it sometimes helps to figure out where we're going by recognizing where we came from. So capital markets being very cyclical as they are, everybody experienced, we knew this was going to happen. Public markets are trading at ridiculous multiples, and so the market corrected and everything came down. Last time we were doing this, it was just before that, and we actually called it. It did correct. Where do you guys think we are now? I know you can only tell, and so no one's going to be able to call you on this, and because you can only tell looking in the rearview mirror. But where do you think we actually are today in the capital market cycle, both public and private markets? Start with Moyen. Let's go for it.
Sure. I guess these are very difficult questions to answer. You can go back and review the answers 6 months from now and realize that you were so wrong. I guess I would start by maybe sharing my experience on the on the private capital side, on the venture capital side, what I've been seeing over the past 2.5 years, in terms of like private capital fundraising. So I would say for early stage VC, we have obviously seen a flux of investment in 2020, 2021, after COVID, mainly 2021, that got to its peak maybe by the end of 21. As we enter 22, like people realize, oh, the dry powder is finishing, so they got all scared, and that was the beginning of, I guess, more a recessionary feeling for us. We realized that there was less capital available. A lot of our portfolio companies wanted to raise, were facing a lot of challenges in fundraising. That was mainly the flavor in 21, 22, and 23. I would say probably beginning of 23, we actively started investing because we realized a lot of VCs aren't investing, but I know that the market was really, really down. Nobody was really deploying funding. I would say probably September 23 that has started to change slightly. It's picking up again, but one of the biggest things that's still the case is that even venture capitalists are having challenges fundraising for their funds. So that is still the case. It hasn't resolved. The feeling is that you're coming out of this recessionary phase, at least on the private side. But it's like when you are, let's say, an emerging manager on the venture capital side, people say it's not going to be easy for you to raise funding. When you're a seed stage, pre-seed stage, we still tell our portfolio companies that it might take you, instead of 3 months to raise your round, 6 months to raise your round. So prep in advance. This is still the case. It hasn't changed, but we're hoping that it would change by maybe September end of this year. I think the interest rate might come down soon, as the inflation is at now 2.8%. So hopefully that would change things.
Randy,
Do
you agree?
Yeah. Oh, I was going to actually pile on and like put my Grim Reaper hat on with a little bit of a sickle, right? I was going to tell a story, but I remember in 2008 where you tried to hide your money in the public markets after the real estate crash, but then the public markets had a crash, and then you put your money under your bed and the rats ate it. And I actually think last year was worse than that. So I think 2023 for me, in doing this for 20 years, I would say last year was the worst year I've ever seen. And it actually starts at the top of the stack where Moyne was talking, is that the people who have the money don't believe enough in the private markets to put their money there. So that means that the people that would usually fund a venture fund or would do an angel deal were thinking there was way better places to put their money into than our industry as a whole. We're not even talking about alternative energies or clean tech or anything. Once we get the next trickle down, after you start at the top where nobody wants to give the industry money, then there's a shortage of capital across the industry. Now, when you start to go in the stacks, there's certain industries that can't get any money because it's all going into AI or whatever flavor of the day is, right? And we see flavor of the day over lots of years. And then the interest rates is a huge issue. Like, why would you go and give any of you on this webinar any money? I'm going to give you money. You're going to give it back to me, or you're going to lie to me and say you're going to give it back to me in 5 to 7 years. But we know it's 8 to 10, and it's been bleeding to 12 since COVID. So I can get maybe 16% rate of return annually if I wait 12 years, or because the interest rates are so high, I can actually get 16% interest rate yield coming back to me right now. So why bother taking a flyer on Black 17 when you can play easier games at the casino? And so we're seeing, I saw a lot of that last year. Coming into this year, to Moyen's point, we cut the number of angel investors in our group in half, meaning not we cut them and sent them packing as they didn't want to play. We did 13 deals last year, which is about half of what we usually do. And we deployed less capital. In the first 3 months, so we're March 17th, March 18th, we just did our 5th deal this year, ResVR out of Calgary. And so that's stunning to just come from 0 to 60. So the green shoots are very promising. I probably disagree with Moyen on the interest rates. I think I'm planning differently, that I would suggest they're going to stay where they are as opposed to come down. And I'm thinking in my own thought process up to 24 to 36 months. So, and my last comment would be this, is that Moyen makes a great point about what you should plan for your fundraising round. But the reality is there's a dog eat dog world out there. And if you're a really amazing deal in our space right now, capital is out there. Their money's never the problem in business. It's the easiest thing to find. But what we're all finding is the capital is going into the super ridiculously hot, can't lose deals. And there's no money for deals like yours, which is maybe kind of, sort of, it might be okay, and you're kind of cool. So you've got to be in this extreme space, which has always been the case in private capital. Yeah. But now that, the disconnect between the top 5% and the other 95% of the deals is horrific.
Right. And that's, I think it becomes even more, because there's less capital available, being able to tell your story, because you're correct, right? Investors their job is to place capital. That's what you have to do. You have to generate a return on that capital for your bosses, your investors. So having the right product in your portfolio is absolutely critical, because otherwise, why would you do this? There's, I take a look at, and it's some of the challenges you said, what's the flavor of the day? So there's going to be a lot of issues or a lot of things chasing AI. But the thing is, we've had this in the past too. People chase, like, whether it happens to be cannabis or it happens to be blockchain or whatever, like pick your one that becomes the flavor. So being able to communicate to those investors, I think, is absolutely critical, which goes to Moyen's point. It's going to take you somewhat longer, but you better be making the right thesis and the right statements as why this is the case. It's not a case where you can say, well, just because I'm in SaaS now, well, that's going to get capital, or just because of this or that. Like, that's not the case. So, okay, so we're heading into challenging times. We saw that there has been a reduction. The IPO market's not clearly still not open yet, so it's harder for the later stage ones to get their exits, which makes it harder for the funds to actually raise even more capital. But when you look at, to your point, what do you think are going to be some of those areas that are of real interest? I've seen, like, even during this downturn, it seemed as clean tech, early stage clean tech did hold up because the LPs were driving your behaviors where you're going to invest. It
Yep.
wasn't as much of your choice. You now need to find where the money wants to go. Any thoughts on that, Randy? Like, you gave me a thumbs up, so hopefully Henry
Yeah.
will weigh in and
Yeah.
tell me
So
I'm
I'm
bad.
sitting and I see in the background, you guys won't be able to see it, but my mandatory Mark Carney, how pension funds invest in ESG, right? And it was like it
Yeah.
became mandatory. And oh my gosh, we got to figure out how we throw some dodgy ESG component into our deals so that we could get pension fund money. I mean, you are correct. We came through that. But my nod was actually it's actually a good time to be in what I'm going to call the whole stack of alternative energies, or ESG, if you want. There was a time where a lot of anything in environmental was nuclear winter. Like, do not bring it. Carbon credits needed government backing to be successful. Everything needed a credit. Everything needed government support. Interestingly, James, in the last 8 months, I would see that the top 5 deals I've seen were all like waste to power, waste to fuel. And what's interesting about those deals is that they're not coming as, I'm going to get an angel round, I'm going to get a VC round, I'm going to get a Series B round, which we're all taught this is the way you do things. They're actually approaching us exactly what you said is how the pension funds would have invested in them, which is you set up a limited partnership with a GP, and then there's a 25-year payment yield on it as an LP GP structure. So to the company's credit, if you have no clue what I just said, don't worry about it, look it up. But this is part of the important about what we're talking about today is traditional deal structuring models are being broken down, and people are looking in their own industries to say, what's a better model for us that are going to make the investors want to participate? And so you're now finding angels want to participate with pension funds to get this annual yield. And the VCs, well, guess who gives them money? It's the pension funds. So they want to make their LPs happy by doing structures to make their LPs happy. So we're seeing a kind of a breakdown like that in the environmentals and alternative energy. So that's, the nod was, it's a good place to be, but not in the traditional structure of angel, Series A, Series B.
I'm so happy to hear, because, like, just continually repeating the exact same thing, expecting a different result is kind of fascinating. Somebody had something famous to say about that. Moyen, what's your thoughts on that?
I mean, definitely clean tech is an area that is of interest to a lot of folks. I've and to Randy's point, I've seen fintech VCs start clean tech funds all of a sudden, and you're like, oh, that's interesting. How are you going to underwrite that risk? Because you're a fintech investor. But that's definitely like there's a push from different sources, and as Randy mentioned, a lot of the limited partners of the venture capital funds are institutions that now care a lot about environmental and social and governance aspects of things, and they want to demonstrate that they're actually doing things to, let's say, their customers, and it basically, it's all interconnected, and that's why everybody is now interested and excited about clean tech. I mean, the underlying reason, hopefully, for everybody is that we have just one planet Earth, and we have to do our best to keep it alive. And hopefully, technology in the clean tech area would be the way to do it, to get to that net zero, to get to that like limit the increase of the temperature. I don't know, like I live in Toronto. This winter was said to be like one of the warmest winters historically. We probably had like twice the snow, which is a good thing to live in Toronto and have twice snow, but it's also concerning that like you're getting to a point that is obviously an existential risk for human beings as a whole. So hopefully that's the underlying reason, and not just like satisfying your limited partners and following the flavor of the day. But that's definitely one. I mean, AI is obviously another one. It's in at the like peak of the hype cycle. For a lot of funds, I would say at Green Sky, we try to stay away from hype cycles. We never invest in hype cycles. Like if you show us a generative AI company, our question is, what is the assurance that nobody else is going to do this in the next 2 months, and somebody else way more well-funded than a Canadian company, let's say an SF, would do that? And like you can look at Y Combinator's list of companies for the past 2 cohorts. You pick AI for accounting. There are like at least 5 companies in Y Combinator's cohort that do AI for accounting. And so how will an investor be able to distinguish which of these AI for accountings are going to be winners?
Yeah.
You're making a wince because a couple of the Valhalla members here, of course, we saw AI for accounting deal last month. Like I'm going, yeah, okay, that makes 5. So just
Right.
making your point. I can't believe you picked that one.
But that's the thing, is that there is so much of this herd mentality. And when I look at the companies themselves, they're not necessarily asking themselves the right question of like, my standard 2 questions: what's the problem you're solving? But who owns that problem? Not like, no, get rid of the arm waving. And when we don't do these things, we get this exact same thing over. So I'm just going to do a reminder to the participants. Anybody that wants to ask questions of you guys, please put it in the Q&A. That way the guys can actually, it's easier for them to answer it either directly or through this. So put it in there. But we do have, I saw a couple questions in the chat that I'm going to bring to, and I'm going to phrase it a little differently than they've said. But what are some of the successes in clean tech that you guys have seen, either by a company or a sector, that they did hit it right, they did pick the right areas? When you did talk, or you guys were talking about the waste to energy, there's all sorts of different areas, but let's see a little bit more specifically, where do you think this puck is going when it comes to the clean tech space? Where is capital wanting to get involved? And then I'm kind of interested to know why too.
Yeah, no, definitely. I would start by saying that just having the label of clean tech doesn't cut it. A company has to be economically viable and financially make a lot of sense, and then also have a clean tech angle to it to make sense. So if you're offering a solution, let's say to the construction industry, you have to lower their costs on a couple of fronts and also be assistive to their emission reduction goals. That would make sense. But if you say, I reduce your emission, but I will increase your cost, and there's no ROI for the time being, that would unfortunately not work. So I would start with that. No matter what the technology is, what the area is, it has to make an ROI sense in addition to, let's say, emission reduction, carbon credit, etc., which will kick in. One company that I can highlight from our portfolio companies is a company called Brickeye. They do sensors for the built environment for construction sites. So specifically, they start with the concrete pour all the way to the construction process. They start by, let's say, their main objective is reduce the time for the concrete set and increase the efficiency of the construction process. So that has directly meaningful increase in the ROI for whoever is doing the construction. But then that means that there's less idle time. You can manage emission, you can manage noise, you can manage water consumption, you can manage all these things with various suite of sensors in the construction site and have positive environmental impact. But it starts with, I'm going to make your process more efficient, and as a result, I'm going to give you ROI. But on the side, look at this, you're also reducing emission.
Yeah, it can't be. This can't be just about the social side or the ESG side. If there's no economic benefit, we're face it, we're dealing with a commodity in energy. So if there isn't a real return, why would anybody interested? Randy, any thoughts on that?
Tons, and I'm glad Moyen went first because I'm trying to think about how I want to tackle this. It remains consistent with what I was talking about at the beginning. Is I would actually say we're, and it's not your fault, James. It's because I know you feel passionate about this too, because we talked about it before, but we did the usual thing on these panels, which is what's hot right now. And sometimes I think we give you guys all a disservice by starting that, because the first thing Moyen and I did was we dissed the fact that people are chasing generative AI and they're showing it to us. And I feel that somewhat times there's this movement where you kind of go to like an accelerator or somewhere, you start an ideation process for, I want to be an entrepreneur and I want to do something. So what should I do? And then we've just fed into that. And I loved Moyen's answer because the point is, it doesn't matter what you do. So it's going to be about returns and customers and users. I don't even care if it's social, because if you're doing social change the world stuff, there's ways to finance that too. So whatever you choose, there's a tool to finance that. What I would love to see more of is just some passionate entrepreneurs who pick a spot they really care about. They did that thing James talked about, which is they've got the problem and they've got the solution. They bundle in what Moyen's talked about, is they've actually executed. And that's a huge word here. It's not don't get focused on ideation, get focused on execution. So it's the packaging of the problem with the solution with a customer that you can prove to us. And then sometimes let us do the modeling for you. Let us decide what type of money you should use, whether it should be debt or equity or social impact money or government financing. I saw somebody put in there, there's lots of government funds around there. So yeah, so I have to say that every problem in the environmental and alternative energy space is a good problem to solve. I love Moyen's thing about we're trying to save the one planet thing. Every problem is worth looking at. And I don't think as an investor, we've been super focused on one over the other. We've financed, people needed money for wind farm projects, and we've made money on waste to energy with a company called Kineticor. We did venture debt financing against an SDTC with a company called Anaconda. All three of those were highly successful for us. But in each way, we used a different tool to fund them.
And see, being I love finance. I'm passionate about it, because finance to me is just a tool to enable you to do what you said, to execute on a plan. It's like there isn't a very specific one. There's a question in here that, and I think you may have addressed it. It deals with what are the alternative deal structures that come into play. And I think so long as you've identified, and I'd like to challenge you guys on this, is when you're communicating with the investment community, if you're able to show that you have there is a real problem that has to be addressed, and you can identify very specifically who's bleeding from the neck in this, and here is the execution pathway, you can work with your financiers to come up with what's the most appropriate deal structure, because I don't know that there is just one. Do you want to weigh in a little bit about that?
You're okay, Moyen. I'm going to go first because I'll be crass and offensive, and then
Good.
you're going to have to solve the old venture capital white guy problem. So investing in entrepreneurship just like this is like Tinder, right? So you put your profile out, and there's going to be an investor goes, I love that profile. Let's connect. And another investor is going to go, this person's a moron. I'm swiping the other way. And it literally is this investor deck of individuals who grew up just like you did with cultural backgrounds, religious backgrounds, OCD, ADHD, whatever their issues are, they're still individuals. And on your side, you're the mad founder with you've got OCD or ADHD, and you've got this path or this journey you want to go on. And that's not my journey. I'm swiping one way. But if you're kind of cool and I want to hang out with you and we both know where this thing's going to be a train wreck no matter what we do and we're going to fix problems together, hey, that's how I think we should connect. And I think that's where I think we should dislodge entrepreneurs from there's this formula. And I feel like sometimes we go into these things and we tell you there's a formula, you got to follow the formula. No, the formula is this is who I am. This is what I'm building. I think this is the right way to do it. I think I can get you these type of returns. Do you want to hang out with me? I think we need to start engaging those conversations. Moyen might have a formula he's got to give his limited partners on how they get their money back. I've got the same problem. My group goes to 0 investors if I don't deliver the mail. But my group grows to 300 investors and does 4 more funds if we find a structure and deals to go within that structure. So Moyen and I have rules we'll have to follow. But it doesn't mean you have to follow our rules. We might just not be the investor you should be hanging out with. Does that answer? It probably avoided your question, James, more than answered it.
Well, we do like to dance, and we do have a bit about the age thing going for us. So when it's taking the younger approach, and
exactly.
Yeah, 100% agreed. I think sometimes, unfortunately, people think that venture capital is the way to go, and that's the successful way, which is 100% inaccurate. It's like if you don't need to raise money, please don't. If you can bootstrap and like grow your business without raising any money, that's probably the best thing to do. If you have a venture scalable business, you might fit into this exactly fit into this box that we've created. It might be fitting maybe 2%, 1%, or less than 1% of all the businesses that are created. And a lot of these businesses that go out of this box are probably even more successful than the ones that go into this box. So you don't have to fit the venture capital mindset. That's just there's no reason for that. If you're a small business, if you're bootstrapped, if you're generating revenue, if you have hired people and created jobs, you can be a successful business without the venture capital money. But if you're seeking venture capital money, you probably need to like fit a couple of a couple of criteria. But that's not the right way to do it or the only way to do it. There are like many ways to fund your business.
it's interesting. I saw a thing on PitchBook the other day that there was an assessment somebody wrote about how that they don't see the funds that were 21 vintage are they're not going to be able to raise another fund. And if you think about it, when they say place at least a significant probably over the last 3 years placed a good portion of their capital, if it's a 10-year fund, that's what you would expect. Well, these funds are like, it's impossible for them to ever generate a return. Like they would have been now, whether it's today or tomorrow, they're going to be facing a whole bunch of down rounds. They're not going to actually raise again. So there's a bunch of capital that's now going to go up, but that's fine. Like that always happens. What I'm kind of curious about,
I would probably just add that if you are a VC firm that you didn't stay disciplined and gave 20, 30, 50x multiples to revenue in 2021, you're probably going to face that problem. If you stay disciplined, stick to fundamentals and really looked long term,
right?
And you didn't invest in those like emotional times where everybody were rushing to put their money in, you're probably safe and you're going to raise another fund. And hopefully Green Sky was one of those funds.
And that goes to the fact that there's like 50% will actually raise again, because I agree with you. There is that discipline. And I truly do believe in the contrarian side. But, there was a theme here going on. There's some differences going on. And Henry did decide to weigh in and raise the point about there are, because of interest rates, and Randy, you started on this, so I'm going to like pick on you again, because there are when you look at an interest rate environment, you look at that's going on, there is this opportunity now for funds to have a debt fund, and we're seeing more of these now out there. Obviously, at early stage companies, you're not going to go to the bank. Like, don't waste your time talking to any of the banks. It's just a waste of time. But you know, we did have that a Silicon Valley Bank that blew up, but it blew up for not necessarily the reasons that are behind. True, you can do venture debt.
Yep.
So there is real opportunities here, and there is, to your point, potential to go longer than just using the venture debt for the bridge between rounds. So thoughts about these for the right type of company. I'm not suggesting all of them. It does have to match, but do you want to talk about this non-conventional debt coming into play with respect to these companies?
Yeah, so I'm trying to think about it in a sound bite so that if you're scoring at home. So when you're putting a deal together, Moyne's already made the point that we've kind of taught you that you're supposed to go this route, and we put you on this journey. And the biggest disconnect in the journey isn't how much you should raise. Moyne's already brought up the disconnect between valuation and what you're raising has caused a lot of stress for VCs. But a lot of you that raised money in 2021, you get the bad dog, no bone too, because you raised money at a valuation you couldn't support, and now you're fornicated, and it's all coming crashing around you. So if you're like me, I have a BA in poli-sci and English lit. I have an advanced high school degree. And I became an entrepreneur. That does not make me a finance person. So you're all busy building product and trying to solve problems and execute on this. But as an entrepreneur, as a founder, you've got 7 things you got to do all at the same time. And you got to teach yourself to be a finance person. So Finance 101 in this space is, what am I building and what's the realistic exit space? If you kind of have a sense of where you're aiming for the exit space, we can now go backwards and start to engineer each of the steps. And the first step is you would go see me at Valhalla, and a bunch of angels give you $250K. It's probably a convertible note, because the right answer is we don't know whether this is a good equity or yield play yet. And then we get that kind of solved. And we want to go see Moyen for that 1.5 mil, but we didn't execute the way we thought we should. So we got to put some cash in the middle of that. We call that the bridge. And so do we do a bridge where we raise more equity from the angels, or do we go get some debt, which we can plug in, which gives us 200 grand, which gives us enough runway. So when we go talk to Moyen, we're kind of hitting his numbers. And then Moyen's going to say, well, I can do 1.5. And you go, great. Can we do 1.5 at a 20? And he's going to smile because he's from Toronto, and he's going to go, you're kind of cute. But in Alberta, we would tell you something about fornication leaving. And so you're going to have that conversation about engineering valuation at Series A. But the whole point of the conversation is not what you think it is. It's not about angels screwing you or banks screwing you or green sky screwing you. It's literally about, what do we think you can sell for at the end of the day that gets us into the multiple where our bosses, angels or LPs, are happy? Canadians don't realize that the average SaaS company in Canada sells for $22 million. And when you engineer backwards from $22 million, you instantly recognize how the valuation conversation is wrong. So you do not live in San Francisco, New York, or Boston. Do not go look up some company from San Francisco on NASDAQ and come to Moyen and I and tell us that that's going to be your exit number. tell us what somebody in Canada bought your company for in Canadian dollars, aka Northern pesos. And now we both are having the same conversation. I'm trying to make you successful. You're trying to help me be successful, all with the right numbers. And then we can engineer where the debt, where the equity, where the fireworks equity of the VC comes in, where the bridge money of the venture debt comes in to get us to the fireworks. And how do we keep our friends, family, and angels happy fed along the way? So I wanted to kind of take a broader approach to, like, debt fits in on the stack, VC fits in on the stack, but understanding the stack with a BA in poli-sci and English Lit, the only number you really need to know is what's the realistic exit for a company like yours, and we can start to work with you on that.
I was going to give Moyne a different question, but given that you decided to raise Green Sky and Green Sky's what they're going to do to the companies, I figured let's let Moyne talk about that for a second, and then I'll raise my next question, you guys.
No, I wanted to say that Randy is right. That's really how it is. Like you come to us, you haven't hit your number, and you want to raise a 20 mil valuation. We would look at exactly the thing that we would look at is that what is the exit potential? Like what are the ROIs for us? What is the IRR of this deal? When would it exit? How much would they buy it for? And we would definitely not go look at that NASDAQ company and that revenue multiple. We would look at more realistic revenue multiples that are in the market that we're seeing. And then we would be like, okay, it's fintech, so it's 2.5 now, unfortunately. It used to be 14, it used to be 21, but now it's 2.5. And maybe a forward-looking multiple is better than this, but today it's just like the bottom of the pit. And that would be the baseline for us to look at what would be the value. And if you haven't hit the revenue number to kind of back that value, then it's very difficult for us to get connected. And that's probably where additional funding from angels, debt, other sources would come in to like keep you going to get to a point where you're like, okay, I've now hit that number, or you're like, okay, unfortunately, I can't hit that number. This is the time for me to bite the bullet and go down route, which is unfortunate for a lot of the entrepreneurs and their previous investors.
You guys raised something that to me is absolutely one of the most important things that the entrepreneurs have to look at, and it's something as an investor you intuitively do. You do not take a position unless you understand how you potentially can get off that position. So when we're looking at this, it's how do you plan to create a liquidity event? We know it's not going to be correct, but is there that potential? And you guys are right that we don't work our way backwards to the point of saying, well, here's the comps, give me the real ones. And just like Randy, you did, like, these are the real ones that are out there, point to it. Change the dialogue from this arm waving stuff as far as, well, I'm going to have a 20x return. No. If I get to this revenue based on these multiples, working backwards, this is the amount of capital I need to get from where I'm at. It's like I'm saying, I'm going to sell you a car. But what we tend to do is when we look under the hood, all you've done is you created this unicycle. Like, well, you can't sell the unicycle to somebody that wants the car. Like that's just plain dumb. Mr. Freeman has weighed in on this, and
I was about to answer his question.
I want you guys to actually.
He's right. He's dead right. The worst thing about the industry you are in, it's massively capital intensive, and it takes ridiculously long time. So when I said 7 to 12 years, and Moyne's nodding, and I'm nodding because in venture and angel investing collectively across blockchain, fintech, et cetera, we're looking to 7 to 12. Some of you are on a 25 to 30 year cycle. And so James brought up the comment about what do you do in these longer cycles? And he should have added to his question, and I need more money than your average fintech. So I was going to talk about the concept of bus stops and give the example of the old traditional energy. Like, what I love in more sophisticated finance markets, and I'll give Paul Cataford credit for this, who used to be at UTI. He said, when you look at how energy finance works, somebody comes along and they build a junior oil and they raise friends and family money on penny stock and they stick it on, some junior exchange. And they get to 10,000 barrels, and then the usual suspect comes along and buys out the junior, and then the 10,000 barrels becomes 50, and they sell to somebody in corporate finance put together by ARC, and then when it all ends up, the big five eat it up. But along the way, the people who do penny investing, they got money out, and then the people who do 50K to 150K, they got money out as they hit the next bus stop. And then all of a sudden, people are doing $10 million from pension funds. So in other industries, there's ways for investors to get out along the stack. And so I think that is a really good way for you as you're approaching investors, is maybe when you come to me as an angel investor, say, you're not going to be here for 20 years. My objective is to take you out in 5 years. That's why I did a convertible note with an interest rate. I'm expecting so-and-so to take you out. Or if you'd like to go for the long ride, I'll give you the option to stay. So again, we're still back in that deal engineering, but I see that more often with all of you is you should be looking at what is the bus stop. So we've talked about that exit at the end, and then the 6 places you raise capital. Think about those as bus stops. How do you take people onto the bus and how do you get them off the bus? That's super helpful for investors. And the other thing, the last piece on this, James, Freeman and Jeff, I actually think the problem you all have in this industry is you actually care too much. And I mean that as a sarcasm. I love the passion and how religious you all are about what you're building. Don't lose that. But the problem with that is that in these other places where you get dispassionate entrepreneurs, they're happy 5 and done. Like, I'm building some cheese ball mobile app, and I'm quite happy somebody takes me out in 5 years. Some of you, this is your life's passion and your life's work, and the concept of an exit really sucks. You have zero interest in an exit. So when you hear Moyne and I talk about exit, or James talk about exit, we're talking about exits for us. And if you want to stay, you can do that. But just think about, we don't want to stay for all of your life. How do you get us off or on at a various bus stop? Hope that kind of gets to James's comment. But he's right. This is the worst industry for needing the most amount of money and the most capital intensive.
Yeah, well, and you deal in deep tech, so like energy tech, deep tech, these are all hard tech. They're all capital intensive. What are your thoughts? Like, I actually like Randy's analogy, because in oil and gas, they actually set it up, the junior, intermediate, seniors. We actually had that process where you took a company, you only took it that far, and then you sold it. So you created the liquidity event, and then you did rinse and repeat. You just did it again. It's harder in this to actually do that. You're actually creating it because the industry is not set up for that. But really interesting thoughts on it, Moyne.
I mean, the question is that is there the right mix of investments, government funding, etc., available or not? I would say that one of the funding sources, that is SCTC, really helps us like move forward with an investment in the clean tech area, just because, again, as Randy said, 10 years is the thing of past. Like, the exit is not going to happen in 10 years. And if we are a deep tech investor, if we are a clean tech investor, we have to know that we have to be patient. So it's going to take longer. This is not a 5-year exit. It's going to be longer. This is not going to be the last round, or like maybe the round before the last. There are going to be 3, 4, 5 other rounds after us coming in. So there are going to be 4 or 5 other bus stops happening. And it's probably not easy, again, and I guess the difference here is that it's not easy for us to take off the bus. We have to like continue, especially if your check size is 150K, it's more difficult to buy you out in the secondary. So you just continue for the 12 years, and you have to be more patient. You have to have the right portfolio structure as a fund to be able to fund a deeper tech, hard tech investment. And you have to have the right conviction, I guess. Not all funds are set up to do that. Some funds are like don't have that expectation, don't have that big of a fund size, aren't able to do follow-on rounds, and as a result, they don't go into a more capex heavy business. And some funds do, and they go in. Do we have the right number of funds focused on hard tech? I definitely think we don't have enough funds focused on hard tech, deep tech, clean tech. We still have a lot of funds focused on light kind of capital software as a service basis. We would have, I guess, as the beta in SaaS or I guess alpha in SaaS goes down, people would move forward to like find these I guess inefficiencies in deeper tech investments in the private market.
Okay, I'm gonna turn a little bit. Let's go away from this and talk about. So we've got, and I've warned against doing this, but I'll do it anyways. Political environment. We're going to see things happening in the US, things happening in Canada over the next while. We have global issues. Obviously, there seems to be real interest in and we're like tech related to military, like huge interest going on, AI associated with it. What I'd be curious about is throwing all of those things into a bag, shaking it up. What's your call on what we're going to see over the next 12 months in capital markets, including both VC, PE, and I know public's not your guys' area, but obviously public does influence what's going on. So you need to have a view with respect to that.
100%, yeah.
So who wants to go first? And this is our I'd like to call you guys back in a year's time and go, hey, let's just actually see what happened. So who wants to take that one first?
Randy is going to be more accurate, so
So I just
let him.
I just threw out there. So you think about where we came like 18, 19, 20, just as SoftBank and Tiger really effed up the VC marketplace, right?
Yeah.
We were also seeing this funky little thing pre-COVID called a SPAC. And I have to tell you, I love those things. But then when I looked at a SPAC, it was like the old Canadian CPC structure
That's
done
all it
on
was.
steroids, right?
Yeah.
So I think everything new is old again, or vice versa. I put in a answer to Henry's question, the rise of venture debt. Like, yeah, I thought I was pretty cool in 2017, but everybody and their dogs got one now. But, Moyen raised at an amazing time. We had 30 out here just in Western Canada. We had 30 micro VCs pop up, like these 1 to 2 million, 1 to 5 million. Everybody with an MBA and under 35 wanted to do a micro fund, right? So you see these and they're not trends as much, James, as people trying to solve real problems. Markets are ridiculously frothy right now, ridiculously frothy. And so I think we're going to see something like this SPAC that we haven't seen before, but in fact, it's just a reiteration of how we used to solve problems 20 years ago. James Freeman followed up and said secondary markets. I've made money 3 times in the last 14 months by selling in a secondary. And it wasn't even like a pipe, a Plaid, or a SpaceX. It was literally one of the VCs trying to clean up the angel table. So I'm going to say something's going to come up that allows for bus stops in our industry in the next 12 months, because time is becoming the enemy of our industry. Like when I started post-bubble, we were on a 5-year exit. Then we hit 2008. It was all the problem of the financial markets is why it went to 7 to 10. And now it's COVID's fault, but we're now, 10 to 12. So time is not the friend of the investor in this industry. And I think we're going to find more things that are people finding innovative ways to use either yield, find secondaries to get investors out along the journey, or some other kind of tool that allows you to be involved in equity for a shorter period of time. I think that's the problem investors are going to try to solve. And if I make one more comment on some of the comments in here, a lot of you are still trying to game the system about what are we looking for and how to label yourself. This is actually a really good time to be an entrepreneur. You're less screwed than we are. So you have to remember, we go through these cycles. I think the 2021 cycle was still your cycle. You were coming in and claiming ridiculous valuations, and you're going to pay for that, by the way. That's now your fault, but it's still your cycle. Like, as an investor, we haven't figured out the model right now on how we're getting our LPs out cleanly right now. It's still a difficult time, but it's like the 2021 time was different because it was, you could pitch a deal and we would be investing in it. And now it's still your time because we're actually becoming less tunnel vision about what we're investing in. You could be a fintech, but if I need you to look like you're green tech because I need to do a deal that's going to be phenomenal, I will find a way to fit you into my rules if you're a hot company. That has always been the way. So don't get hung up on what your title is. Get hung up on being a super hot company that the VCs are willing to break their rules to get you into their book.
Moyen, last word, and then we're gonna. I agree with you, Randy. It's like a good company, a good investment is a good investment. Like, call it whatever you want, but Moyen, your last word.
Yeah, I just wanted to say exactly that. The fact that doesn't matter if the time is hard, easy, whatever it is. A good company would raise funding, a good VC fund would raise funding, and they would survive. And those are the top 5% that would survive anyway with any label. And if you want them, we would onboard them. Secondaries and M&A hopefully are going to be the two that are happening. You're seeing a lot of secondary funds forming and reaching out to us and a lot of other VCs and early stage investors to buy out their positions, obviously at a discount. And then M&As are also happening a lot more now. I guess the companies at the later stage that have funding, that have money, know that this is actually a good time to buy assets at a more reasonable value.
Well, guys, thank you so much. I could actually go on for next couple hours on this because there is just so much that we could cover. Yeah, your points, like how SoftBank and Tiger screwed up the capital markets, like those are all kind of fun stories, except when you're having to live it. But yeah, I hear you. This next year is going to be interesting. I think we're going to see access to capital coming back in. How it comes in will be there'll be some questions, but your insights were fantastic. I hope you can share your contact information with the markets, with those that are the participants here. And I'm going to turn this back over to Astrid, who will wind us down and walk us out. Thank you so much for everybody that joined us, and look forward to seeing you again. Astrid.
Thank you, Moyen and Randy, for providing your expertise, and of course, James, for the moderation as always, and to everyone for joining us. Before we close up, I have a couple of announcements. The first one is the one that we see on the screen here, is that we have launched the Clean Tech International Co-Innovation Plan with the support from NRC IRAP and Oblique Consultants. This is a new program designed for Canadian clean tech ventures who are exploring global market and looking to scale up internationally. It's a 2 half-a-day workshop with IRAP, and the successful presentation of a plan can lead up to $50,000 in funding to execute. So it's a super cool new program. I'm going to paste the link here in the chat for the application. But essentially, if you have 10 full-time employees and over $500,000 in revenue, you will be a great fit for it. And another announcement is on our next session, and the next Fireside Chat will be about building a dream team and strategies to staff. The event will be on April 24, and it will be posted on the website very soon. So stay tuned for that. And that's it for today. Thank you, everyone, for a great session.